Now, the same is true for Bitcoin. The same is true for any other scarce asset. And it just so happens that currently the biggest two ones, Bitcoin and stablecoins, are ones that give more access to a lot of these countries than other that they previously didn't have. So a lot of these countries, they already had access to gold in many cases. They often use local real estate as a kind of a placeholder for value, something more scarce than the local currency. And Bitcoin and stablecoins mainly have the advantage that over a video call or a DM or even transferring value through borders, there's greater density and ease of access there. And so the biggest losers are the ones in those countries that don't transfer over to better monies once it becomes available for them to do so.
As a result of escalating geopolitical tensions, declining currencies, and mounting budget deficits, the world economy is changing. According to Lyn Alden, the conventional financial models are about to collapse. Any attempt to boost the economy by lowering interest rates might set off strong trends, from a resurgence of the gold and Bitcoin bull markets to volatility in bond markets and fiat currencies, as central banks are caught between inflationary pressures and growing debt. Alden also highlights the widening gap between fiscal and monetary policy and how it contributes to capital rotation toward hard assets over the long run. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
That's still not an offset. It used to be an offset to the rising debt levels, and now it's just kind of in the static range, potentially. And then in addition, if you do get a much lower interest rate, right now there's this kind of like there's still a hawkishness behind the dollar. So there's a lot of developing countries out there that have dollar-denominated debt. It's something like $18 trillion in dollar-denominated debt. I think of which 13 is like held by non-banks and the rest is held by banks. You know, that's in developed countries, that's in emerging markets, it's kind of all blended. That's part of the euro-dollar system. And all of that represents inflexible demand for dollars. So when the dollar gets kind of strong, it squeezes them. If we do get a much lower interest rate on the dollar, that allows a lot of those other countries to ease their monetary policies as well, because they're not kind of struggling against that strong dollar as much. You potentially get kind of a BRICS boom or like an emerging market boom cycle. You potentially get higher energy prices from that. Right now, because of the more sluggish global economy, it's one of the factors keeping oil prices pretty much in line. And so that's another factor that can kind of happen. And then at the conference, I highlighted that gold and other scarce assets tend to have this inverse relationship to real rates historically, which is, if U.S. money supply is growing at 7 or 8% per year, most people aren't looking at that. They're looking at CPI, but still, it's growing at a pace. If they feel like they're getting paid 4 or 5%, they're more willing to hold on to that, especially in this kind of regulated environment they operate in. But if they're getting paid 0, 1, or 2%, and that money supply is still growing, they're more likely to get into gold or in our case, Bitcoin. And so even if we get this kind of low interest rate environment and deficits slow down a little bit, that's still really good for the assets that I'm talking about. And so that's kind of the wonderland snare we're in now, whereas higher interest rates have one mechanism of accelerating this and lower interest rates have another mechanism of accelerating this, because it's kind of less of a free lunch now than there was during the structurally declining interest rate environment. And I think the final point on stablecoins is that it's I view it less about getting the number of dollars out there. It's partially, it impairs in some ways the exchange rate between the dollar and other currencies, and kind of the thing that can happen is let's say you have this kind of country with an increasingly impaired currency. It's a developing country. It's got say 20% dollar backing for its currency. Early adopters that say previously had trouble getting into dollars due to border restrictions and other things and bank restrictions, to the extent that stablecoins allow them to get into dollars more than they previously could. Earlier adopters that do that benefit, because as people get out of that local currency and get into a more backed version of the dollar, the other ones potentially are the ones that are transferring purchasing power to the ones that got into stable coins earlier. Now, the same is true for Bitcoin. The same is true for any other scarce asset. And it just so happens that currently the biggest two ones, Bitcoin and stable coins, are ones that give more access to a lot of these countries than other that they previously didn't have. So a lot of these countries, they already had access to gold in many cases. They often use local real estate as a kind of a placeholder for value, something more scarce than the local currency. And Bitcoin and stablecoins mainly have the advantage that over a video call or a DM or even transferring value through borders, there's greater density and ease of access there. And so the biggest losers are the ones in those countries that don't transfer over to better monies once it becomes available for them to do so. Another point that I made is like, people can see one or two bubbles and dismiss them. So if they see kind of Bitcoin rise and collapse, like, oh, the bubble's dead, they don't necessarily go look at the log chart and see that there's been a couple bubbles. They only can really often know the bubbles that they saw. And the first really public bubble was 2017. Then there's the whole second bubble, but then people could be like, well, that was COVID, that was the money printing thing. So we got this kind of second aftershock, and people were able to dismiss that. But now it came up a third time. So this is the third quote unquote bubble that has been in the kind of the public realm, with the prior ones, the prior bull markets being kind of sub-public level. And people can't really ignore things more than 3 times. I think that's kind of the magic number, where it's not an accident, it's not a fluke. Maybe I should actually pay attention to this thing. That's certainly what happened to me. Just forward it a little bit. Like, I would see Bitcoin have a cycle, one of its early cycles, and say, that's neat, it's cool. And then I kind of forget about it, and then it has like another bigger cycle, and I'm like, oh, that's actually still here. And then it kind of goes through a bear market, and it goes to the third cycle. I'm like, okay, I'm not going to mess this one up. So I finally figure it out. And I think that's the important thing, is that's now basically happening in the public realm, where we now have 3 cycles that are all relatively public.
We're going to explore fiscal dominance, a powerful idea that rising U.S. deficits and growing interest payments are changing the rules of the economy. In this new reality, central banks may no longer be able to raise interest rates without causing serious problems. This video shows why this change is important for investors attempting to manage the erratic markets of today, and dissects Lyn Alden's most recent study. For further updates on Bitcoin and the wider world of digital assets, please take a moment to like this video, subscribe to the channel, and enable post notifications before we go any further. Thanks, and enjoy the video.
It's not going to happen. It's not going to crash. And it's just going to keep going up. And eventually you're going to have to adjust your mental model and join the orange train.
I think the problem is that there's so many things that people kind of have to get, like the hurdles they have to go through to get that. One is like, can digital things have lasting value? That's one of the hurdles people get through. Another one is, okay, so if digital things can have value, what prevents all of these from having value and depleting the supply? So then they have to kind of see why network effects and self-reinforcing scalability really matter. And then they have, so there's like a number of steps that people get through. I mean, that's partially why we both do what we do, is to kind of educate and share what we research along the way to try to be part of this information trend. So as information gets more, easily out there, it still relies on people doing work, doing research, and sharing it with others to say, here's what's happening. Here's, here's arguments I'm seeing. Here's answers to those arguments. And over time, people get it. And so that was kind of my whole endeavor back then. And I started using the phrase "nothing stops this train," I believe around early 2023 or so. And that was because we went through this very, very brief window where we had a narrow fiscal contraction. So in 2020, 2021, that was like the crazy money printing years. 2022 is when they really tried to hawk it up. They tried to, they raised interest rates. Most of the kind of the pandemic era programs were like dialed back to some extent. And so we saw this contraction in the broad money supply. We saw this contraction in private credit. We saw this reduction in public deficits. But by kind of late 2022 or early 2023, as public interest expense ramped up, federal interest expense on the debt, we actually started to get rising deficits again, even though they were still trying to be hawkish. And so that's when I kind of emphasized that we are entering like kind of another cycle now of where fiscal's leading again, less explosively than that whole 2020 and 2021 period, but more persistently, in the sense that it's not tied to any one catalyst. It's not this like one thing that's happening. It's back to the broader trend now on steroids. And so my key kind of emphasis was kind of fading some of the disinflationary themes or even some of the recession themes, and instead emphasizing that when you're running 6 or 7% deficit of GDP, that's a pretty different investing environment and a different economic environment than many people are used to outside of a recession. And that has all sorts of implications. So I've been kind of pounding the table on the power of fiscal before the pandemic, during the pandemic, and now even recently after that whole period. Yeah, a lot of these things are happening together, which is why it's so persistent. It's a really big Gordian knot, and that's why I keep fading any attempts that they're gonna, claiming that they're gonna get back on track. I mean, earlier this year and kind of late last year after the election, there was this big idea that Doge and Elon Musk are gonna get this back on track, and I was just looking at the math and saying, it's almost impossible. There's very little that they're going to be able to tackle that will actually get this back on track. So one, demographics. Basically, for decades, the baby boomer generation, which is very big, was paying into the system. And now that they're effectively retired and increasingly retired as the years go on, as even the youngest baby boomers start to retire, they're now in big drawdown mode. And so over the next 10 years, the existing $3 trillion in the Social Security Trust, which is held by intra-government debt, it's kind of the wonky accounting that they do, but that's going to basically pour back into the economy and transfer to external debt. And that's spendable income that enters the broader circulating economy. Then there's the interest expense. So like you said, for 40 years, we had rising debt to GDP, but falling interest rates. And right around the same time, the demographics started to roll over. We hit zero interest rates, bounced off zero. And now we have rising debt to GDP, but no longer declining interest rates. So you don't even have to assume that interest rates are going to go up. If they just kind of chop around sideways for the foreseeable future, interest expense starts becoming a very meaningful percent. It just passed defense. It's now like the biggest component after Social Security. And if it keeps going, it'll eventually pass even Social Security. Defense spending as a percentage of GDP was falling for a while as we kind of exited the Cold War. But a lot of things, the kind of theme is things don't have to ramp up rapidly. Just if you have a mild trend change, that can really matter.
Lyn Alden talked about the intricate and escalating financial strains on the American economy, emphasizing how fiscal domination is altering the rules of the game. According to her, a lot of people find it difficult to comprehend how digital assets like Bitcoin can hold their value over time. Mental obstacles include first acknowledging that digital items can have value, then comprehending why not all digital assets are created equal, and lastly realizing how scarcity and network effects give certain assets, like Bitcoin, its distinct power. She claims that this is the reason why research sharing and education are so crucial. It takes time, regular exposure to strong arguments, and a willingness to learn for people to get it straight immediately. She also considered her popularized phrase, "Nothing stops this train." That term became clear in early 2023. After the wild 2020 to 2021 stimulus era, the Fed had been attempting to calm the economy by decreasing money issuance and boosting interest rates. But at that point, government deficits started to rise once more. The main cause of this was the skyrocketing interest payments on the national debt. That is to say, the administration was unable to successfully tighten policies without disrupting the system. Long-term structural problems, including debt, aging populations, and ongoing government spending, were driving a new cycle that was not influenced by sporadic events. Lyn stressed that most investors are not accustomed to this new situation. It is quite uncommon to run a deficit of 6 to 7% of GDP outside of a recession. It makes the market environment more volatile and prone to inflation. Many people still hold out hope that the government would restrict expenditure. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.